Jerome Powell and the Fed just flipped how they're seeing this market. They flipped how high they think they're going to have to raise. They flipped whether we are at a sufficiently restrictive right now. And they also flipped the economy and what they see happening right now, whether we will hit recession or not. And congrats, because we are at the end of the Fed rate hike cycle, at least for now. This is the end with a caveat. If you don't mind, hit subscribe, turn on that bell notification underneath the video. I'm going to keep this one nice and short. There are going to be a lot of people that give you all different viewpoints on the Fed speech. That's because it was hawkish in some respects and dovish in others. You can see the crypto market is up a little bit after this speech. Right when the Fed came out with their statement, and when we looked at the dot plot here, it was quite bearish. You can see the NASDAQ fell about 1% within minutes. And the reason for that is because we actually saw an increase in the terminal rate for the federal funds rate. So this is what they project they'll have to raise rates by. Last projection back in March was 5.1%. Now they're saying 5.6%. So the expectation is that we are going to have to raise rates 2 more times. However, they're not raising rates now. They've been increasing rates a lot, but now they're going to take a pause. They've been raising rates for over a year now, but this is the rate that they have to stop at. So they're going to re-examine the data coming in. They have not made a decision ahead of time, but they still think that this is not restrictive enough. Now, Jerome Powell seemed a little bit annoyed actually by questions, and he did not seem to be on the same page as a lot of the other people on this committee. So the other people that were pulling up these rates or these projections. Now, the good news is we did see a change in the real GDP. People are expecting us to continue to grow, and this might be part of the reason that we are seeing possibly a higher federal funds rate, terminal rate, is because now they're projecting a 1% change in real GDP in 2023 versus the March projection of 0.4%. Now, they did lower 2024 and 2025, but this means that we are heading for that soft landing. At least that's what they expect. Now, Jerome Powell said nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2%. Not seem super convinced. It was unanimous that we were not going to raise today. Maybe he wanted to raise today, or maybe he just doesn't think that we're going to have to raise in the future. We knew that they would be talking very hawkish to us because they don't want the market to run away and for us to have more inflation. And keep in mind, we have seen so many inflation gauges come down. They did say that their preferred metric, core PCE, has not come down far enough, but it seemed like a total flip from what he was saying in the last meeting. He did say not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate. So a little bit of a change overall in their rhetoric, how they approach this and how they're framing the market right now. But overall, it's kind of a mixed bag. They are expecting growth, more growth than they were expecting before, but they may have to raise rates. At this point, I think it's pretty much more of the same, which is they're going to see how the data comes in. If it comes in and inflation continues to fall, then they will keep it paused. If inflation starts running away or just doesn't seem like it's moving, they will raise rates. Overall, though, I think it is important to remember that it's okay if they raise rates more, right? There might be more assets that fall. We might have some breaking in the economy or some banks or something like that. But overall, if you're a long-term investor, this is probably good for you. It doesn't really affect you at all years down the line, but we have seen assets move up a lot. If you could go back a couple months and buy in when there's a lot of fear, wouldn't you do that? When we're at 10,500 on the NASDAQ? So if we do see some more fear over the terminal rate moving up, great. If we don't, well, then your assets are at new all-time highs. Let me know your thoughts on this underneath the video, though. Thank you so much for watching. I appreciate it, and I'll see you in the next one.